Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to this week's Through the Noise podcast, where we put recent developments in a longer term context while also identifying potential opportunities for more nimble investors. Now, you may have heard many investors refer to the US dollar as the greenback. Now, there's an interesting historical reason why. Back in the mid 1800s, money counterfeiting efforts involved taking photographs of US dollar bills and then printing fake money. Now, cameras at the time could only capture photos in black and white, hence the back of the US dollar bills were printed in green ink as a measure to make counterfeiting more difficult. So not something I was aware of before this podcast myself. But I'm highlighting this little anecdote today because the focus has indeed returned to the US dollar and whether it has peaked. To discuss this, as well as equity market technicals, the outlook for income assets, and recent events in the crypto space, I'm joined by Fook Hien, who will help us understand what all this means for investors. So welcome, Fook Hien. And look, let's start with the broader market sentiment. The US dollar and US bond yields seem to have broken lower in recent days. Would you be chasing this improving sentiment in risky assets?
Yeah, thank you, Manpreet. While we are cautious about broadly chasing this global rally in risk assets, several speakers from the Fed have already reminded us that the Fed is focused on raising rates, albeit at a slower pace, but they're going to raise rates until they see clear signs of a softer job market and inflation coming down to its 2% target. So the Fed's determination to bring down inflation could cause a recession, and that is the reason to be cautious on risk assets. However, we have been positioning for a rebound in risk sentiment in Asia ex-Japan after China's Party Congress. There has been a rapid rollout of policy support after the Congress, so Asia ex-Japan equities and Asia dollar bonds remain our preferred assets, and we think investors should look at those. And a peak in the US Treasury yields would also support our preference for developed market investment-grade bonds and a diversified income basket, especially if we experience a mild US recession in 2023. Now, the key things to watch out for in the coming weeks are one, how the Fed policy could evolve, and two, policy developments in China. So with Fed policy in the US, this week we saw stronger than expected retail sales for October, which suggests consumers remain too strong. And given this, we expect the Fed to hike rates by 50 basis points in December to 4.5%. And the money markets are pricing in another 50 basis points of hikes to a 5% peak Fed rate by May 2023. If we get weaker US data in the coming weeks, of course, expected rate hikes could adjust lower and support risky assets, and vice versa if the data remains strong. So watch out for volatility around the data releases, like the upcoming US business confidence or PMI, the job market data like jobless claims, job openings and non-farm payrolls, and your personal consumption expenditure inflation data. And then moving to policy stimulus in China, the 16-point plan to stabilize the property market and the easing in your travel or mobility restrictions. This suggests a coordinated move to revive domestic economic activity. And domestic activity is increasingly important because your slowing growth in the US and Europe drags down China's exports. So in the coming months, we expect a more targeted lending in China towards your advanced technology and innovation sectors, elderly care, and small and medium enterprises. We have seen some COVID-19 management rules being relaxed, but the rise of new infections suggests that further relaxations are likely to be gradual. But overall, we do believe the measures so far have significantly reduced the downside risk for Chinese assets, and they're likely to help sustain a turnaround in this asset the next 6 to 12 months.
Thanks, Fook Hien. I think that's a great sort of broad overview. But narrowing this now back to the currency markets, does all of that mean the US dollar is set to weaken from here?
Yeah, we expect the US dollar to take a pause, actually, or even potentially stage a near-term rebound over the next few weeks. So at the moment, we see the US dollar caught in a tug of war. You have signs of a decline in inflation have led the markets to price in a slightly less hawkish Fed, which has weighed on the US dollar. Now, the USD uptrend has also seen signs of exhaustion, making lower highs since the September peak. But on the other hand, the strong US labor market and the retail sales data we've just seen, they continue to point to a strong underlying economy. And a rising number of Fed members are acknowledging the possibility of a 50 basis points rate hike in December. They also consistently highlighted that the Fed is likely to continue hiking rates over the next few months. And these would argue that the US dollar could get stronger. So from a technical perspective, the USD does look oversold. So this raises the odds of a near-term bounce. And if we get data like the November labor market or inflation data that surprises to the upside, it could bounce even higher. So for the US dollar index or the DXY, we see 104.7 as a key near-term support. And then you've got 107 and 109.3 being the key resistance levels. And one of the key beneficiaries of the recent US dollar decline has been gold, which has benefited from a weaker US dollar and lower US government bond yields. And for gold, we see resistance at 1810 to 1820, with 1725 providing key support.
Thanks, Fook Hien. You made some interesting points there about the Fed potentially signal that they aren't done yet, and obviously, and what it means for the dollar. But what about bond yields, right? Because there we've similarly seen a leg lower in the 10-year U.S. government bond yield, and that's raised some concerns that whether income investors have missed the bus. Does that move in yields and what you described make income assets less attractive in any way?
Yes, you're right. I mean, yields have retreated from their recent peaks, but we do believe the absolute yield level remains attractive, and we continue to favor adding exposure to our preferred high-quality income assets. And a few reasons why we think income assets remain attractive. First, both the nominal yields and the yield premiums for income assets are still well above their long-term average. Case for our preferred developed market investment grade bonds or your DMIG bonds, for example, absolute yields are above 5%. And for our multi-asset income strategy, the yields remain above 7%. And we believe it remains attractive to take advantage of these yields on offer rather than trying to time a specific peak. Okay, and secondly, the valuation measures remain reasonable. For the DMIG bonds, for example, the yield premium over government bonds, they've tightened by just 13 basis points, okay, a relatively small amount. And a third, we continue to expect the investment grade, corporate fundamentals to stay largely supportive. And the DMIG bonds are also likely to benefit if your rising recession risk result in the falling bond yields across the board.
Okay, so shifting gears a bit to equity markets. We've seen quite a large move in the Hang Seng index. That's obviously quite a dramatic sort of range when you look at it. What can we learn from equity market technicals about the Hang Seng and indeed the S&P 500?
Yeah, thanks. So let me start with the US first. So US equities is a core holding to us. And technically, the S&P 500 has a good support around the 3,600 level. It has been making bullish higher highs and higher lows pattern since the middle of October. But it also faces resistance around the 4,100 level. Asia ex-Japan, though, is a preferred region for us. Besides the potential for further reopening in China, the prospects of a more constructive dialogue between the US and China and the recent policy announcement about the Chinese property sector, these have been positive catalysts. Hence, it's been no surprise that over the past few weeks, Chinese equity markets have driven one of the largest outperformance of emerging market equities relative to global equities since 2009. So the Hang Seng Index, they rose from the bottom of 14,600 to 18,400 in just 3 weeks. Okay, that is nearly 4,000 points in 3 weeks. And putting that in perspective, your average monthly range is about 2,000 points. So this suggests a modest pullback could be coming up. But over the last 3 weeks, the volume in your up days has been 3 times the average volume this year, while the volume in your down days has been subdued. So this suggests strong buying interest. And we think investors could consider buying with the index around the key support level at 16,900. Okay, that is your 61% Fibonacci retracement between your 14,600 to 18,400.
All right. And finally, we couldn't sort of have a conversation about markets this week without talking about what's been going on in the crypto world, where it's been eventful, if anything. Are you worried about a broader fallout from what's going on in crypto assets to the broader traditional financial markets in any way?
Yes, the crisis in the cryptocurrency space, we think, can be characterized by two main features. So the first is a symptom of a crisis of confidence, right? So the loss of investor confidence in several exchanges have led to a jump in withdrawals. And the failure of a major crypto exchange during this run has triggered the second characteristic of this crisis, which is signs of contagion within the crypto asset space, as investors sought to either withdraw liquidity from other firms as they anticipate similar failures or counterparty risk. Now, we expect the contagion to broader financial markets to continue to be very limited. And the key reason for this is that the classic channels of contagion are usually your cross holdings between asset classes or direct counterparty risk. These have been and continue to be very limited between crypto and the traditional financial asset classes. There is a third possible channel for contagion of transmission, which is via the wealth effect, as your lower crypto valuations lead investors to perceive that they have less to invest elsewhere. And that is plausible, but we expect that any impact via this channel to be minimal. And gold also is another thing to talk about, is often cited as one potential beneficiary, given crypto assets were in the past cited as a potential gold alternative. However, the correlation between gold and your major crypto assets, such as Bitcoin, remains difficult to discern. Hence, we do not expect gold to gain directly either as a result of your lower crypto asset prices.
Thanks, Fook Hien. And yes, an interesting point on a correlation with crypto, Bitcoin and gold, where actually, if you recall, we saw the correlations with riskier assets like small cap equities were actually a lot tighter. So interesting discussion there, but we'll sort of take a pause. Thanks again, Fook Hien, for helping our listeners navigate markets, given the events we've seen over the past week. Thank you, listeners, of course, for joining us, as always. So just to recap, the key points, Fook Hien sort of told us about this today is first, of course, that we be cautious about broadly chasing the risk asset rebound from here, given on what are still ongoing growth risks. Second, of course, US dollar strength may not be over just yet. But third, of course, equity market technicals are arguably looking a little bit better, especially for the Hang Seng. And finally, income assets. Yields have backed up a little bit, but we still see them as quite an attractive opportunity, particularly for longer-term yield-oriented investors. So we'll end it there. Thanks again, and we wish you a successful week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.